Next, we're going to talk about how crypto is transforming the payments landscape, and sort of just how we touched on there, blockchains aren't super quick yet. So is there something that blockchains are looking to change, or will CeFi always have its role in the world? Here to dive deeper, we have Luther Maday, Steve Villegas, and Frank Hinek. Luther is the head of fintech strategy and innovation at MoneyGram and has over 15 years of fintech experience. Steve is the Senior Vice President of Global Sales at BitPay. And you may recall Frank from yesterday's keynote on digital identity, but if not, he is the platform and product lead at TBD. The panel will be moderated by our very own Pruitt Martin, who is the co-director of Web3 ATL and co-founder of Blockchain at Georgia Tech. Please join me in welcoming them to the stage.
Good afternoon. Frank, Luther, Steve, very excited for this panel. I think all you guys have a ton of experience in traditional finance and the payments industry, so I was very excited to talk to you guys about how crypto is transforming this industry as, in my opinion, probably one of the best use cases for blockchain and crypto. I guess I've been spoiled a little bit since using crypto so much to send payments to other people that when planning this conference and having to deal with payments in a real setting, it was extremely frustrating. Very excited for what's to come, but to kick it off, I thought we could do a quick intro just on yourself, a little bit more, give you a chance to explain some more about your background, as well as the companies that you work at and what they do for those who aren't familiar. So we can start with Steve.
Sure. Hey, good afternoon, everybody. Thanks for being here. I'm Steve Villegas. And first of all, I want to say thanks again being here on a Sunday afternoon, especially if you're an NFL fan or whatever sports fan going on. So appreciate you guys being here. And I also noticed that the room kind of cleared from the compliance topic to the payments topic, which is usually surprising. Usually it's the other way around, but that's good to know that people are interested in compliance as well. So I've been in the payments industry for about 17 years. I've been in crypto for probably the last 5 years as a partner of BitPay originally, and then over the last 6 months joined BitPay to lead their global sales and revenue. BitPay is one of the oldest, longest standing companies in the crypto space. Our founders actually are both Georgia Tech grads, and unfortunately they couldn't be here today, so I'm helping represent the company. They started in 2009 mining crypto. 2011, BitPay started. And what BitPay does is we help merchants accept crypto without ever touching the proceeds, without any of the risks of crypto. So we, in our back office, manage a trading desk. We accept the crypto. We work in environments across the globe. We are wallet agnostic, and we accept 15 coins going on 18 here pretty soon, which represents about 90+% of the value in the marketplace. We also help with payouts, and then we have our own digital wallet, BitPay wallet, which has its own card associated with it where you can move funds onto cash into that card to be able to disperse out. So we're excited about this ecosystem, excited about where the industry's headed, understanding there's a lot of uncertainties, but we're seeing a massive amount of growth that I'll talk about here in a little bit. Luther?
Hey, good afternoon, everybody. Super happy to be here, excited to be here. Thanks again, Pruitt, for the invite. My name is Luther Maday. I'm with MoneyGram. I'm their head of fintech digital strategy. And everybody knows MoneyGram as the person-to-person money movement company, right? So we've been in business for 40 years, and we've enabled billions of dollars of movement from person to person. As of June of this year, we launched a very critical partnership for us with the Stellar Development Foundation, which was our first foray into crypto. And through this partnership, what we can actually enable is the conversion of cash to crypto and from crypto to cash in 180 countries. So people can actually use their USDC, walk into any of the 350,000 locations that MoneyGram has, and be able to walk out with a local currency in those 180 countries. So super exciting for us and super happy to be here. Jack?
Yeah, I appreciate it. Yeah, so it's great to see all the folks here, and it's an important topic. I think really the first killer app for crypto was payments, and I think we still see the growth there, and there's just still a lot of potential. So for those that didn't see my talk yesterday, Frank Hinek, I'm leading platform product strategy at TBD now, and really what we're focused on is empowering individuals through building a decentralized future that returns ownership and control of people's finances, identity, and data to themselves. And the opportunity to do this in really a way that reinvents what the web looks like, which is a lot of what I was talking about yesterday. And I think, particularly this topic, one of the first products that we're going to be focused on building on these open source components that we hope everybody in the community takes up and is able to build on as well is actually specifically focused on payments. So the ability to use an open network to negotiate the trust and transfer of assets cross-border. And that product we're calling TBDEX, but effectively it is identifying this opportunity to really bring a open network to people's finances, similar to what MoneyGram is doing with Stellar.
Yeah, thank you guys. I think that provided some great context for each of your backgrounds. For those that are unfamiliar with the payments industry, it is a bit complex, right? So I was hoping, Luther, if you could possibly walk us through what an actual maybe end-to-end transaction looks like. What are all the people involved? What are all these steps involved? Why is this an industry that is maybe primed to be revolutionized?
Absolutely. If you look at traditional finance in general, I think everybody here will agree with me is that traditional finance is built on a lot of promises, right? So the way that money actually moves, so when you walk into, whether it's merchant services, when you're using a credit card to pay for a cup of coffee, or whether in our case, when you're actually moving funds to your loved one, thousands of miles away, what looks like a 2-minute or a 5-minute transaction is actually built on the back of a lot of trust, right? So the actual money itself, the funds itself don't move for days at a time, even though it looks like that transaction was done within a couple of minutes, right? So whether you pay for your coffee and you're able to walk out and you see the little approved, or you're able to send a transaction number to your loved one, in India or in the Philippines, and they're able to pick up cash right away, the actual money doesn't move for 2 or 3 days at sometimes, right? So what actually happens during the time is there's a lot of promises between companies to say that, okay, I'm going to give the money to this person, or I'm going to let this person walk out with a cup of coffee, and I'm going to wait for that payment to come a couple of days later, right? So that if you look at any kind of transaction, whether it's millions of dollars or whether it's $2, right? That basically, when you look at it, none of it is real-time settlement. I think what everybody's building towards is ultimately to have a real-time settlement kind of facet around it. And if you look at what blockchain kind of brings in, and especially for us with the help of a stablecoin like USDC, we can actually effectuate real-time settlement, right? So it's a big leap when it comes to the movement of assets, where it's not just like, I think I'm going to send this money and I'm hoping that Steve sends me a check 2 days later, but it's actually like, Steve can send me USDC right now and I can go cash it out, right? And it's that promise that we're actually super excited about with this partnership with the Stellar Development Foundation, where when somebody's trying to buy crypto with cash, they can actually start a transaction on a wallet that's on the Stellar blockchain, walk into a MoneyGram location, give cash, and within seconds, they'll see USDC land in their wallet, right? On the flip side, if they wanted to cash out, they can actually start a transaction from the same wallet, cash out, walk into a MoneyGram location somewhere in the Philippines or any one of the 180 countries that we operate in, and walk out with actual pesos, right? The fact that it's real time is what we're excited about. Steve, I don't know if you want to add to that.
Yeah, I'll just add a little bit there. Do you guys hear me okay? Just from the payments industry itself, when you think about all the parties that are involved and really how credit card transactions started, years and years and years ago, where you have the issuing banks, right? So the banks have a piece of it, and the banks have always been involved in the money movement. And then you also have, of course, the actual networks. We'll use Visa, MasterCard, Discover, American Express as the examples there, where they're passing it. Then you have a merchant services provider, which is typically working with that merchant for you to be able to make that payment or for them to be able to accept it. And then, of course, then you have the banks that are moving all the monies in between them. So a lot of parties are involved, and one of the things that decentralization, of course, has an impact. Of course, the blockchain and crypto payments allow some of those entities to be jumped, if you will, right? You don't have the networks that are involved. The issuing banks aren't necessarily involved, which does two things. One is it definitely drives the speed, as Luther said, and it also drives down costs. So I think there's several elements there that the progression of what's happening with money movement is faster and less expensive, which is really what progression should look like from an industry standpoint. Now, will banks still be involved? Absolutely. I think we saw just a few weeks ago, Mellon Bank said that they would become a custody bank for merchants, et cetera. So banks are definitely interested in this space because they recognize some of the movement. I think that you'll see what the networks do, MasterCard, Visa specifically, on how they'll play in the space, because obviously they know and recognize some of the benefits of blockchain and understand that they're also going to see dollars move out of their ecosystems into decentralized systems, depending on the coin and the block. So there's lots of opportunities there for them to be involved. I think it's really going to be a progression and evolution of the payments industry as a whole, not only faster but also cheaper.
Yeah, I'll add one other piece to touch on. You described essentially a delayed settlement network, right? And so one of the other aspects that creates that a lot of people don't think about, especially if you're fortunate enough to have access to the financial system, you have a credit card, you have a bank account, is that every single payment is essentially a debt, right? Even if you have good source of funds, even if what you think is a debit card and there's money in your account, or even if you're trying to send something like a bearer instrument like cash, there's essentially an extension of credit to that individual, which means that financial institutions have to assess whether or not you're credit worthy to be able to pay. And as a result, there are literally billions of people around the world who don't have regular access to those financial services because they are deemed not creditworthy enough, regardless of whether they have the money on hand. So another aspect of actually being able to create real-time settlement is then being able to extend that access to millions of people that can't today. And so that's a big piece of the promise of this technology, whether through stable coins or other assets, is to actually empower individuals to be able to access and enjoy a lot of the benefits that many of us take for granted.
Yeah, I think you guys touched on, this is a perfect segue into the pain points that exist in the current kind of payments tech stack. And you guys touched on the instant settlement as being a huge, almost like upgrade to what we have now, where it's a debt system, or we have to wait 2 to 3 days for things to actually process. I was hoping you guys could also touch on maybe some of the other pain points in the current payment stacks, things like fraud risk and chargebacks, as well as potentially like the liquidity issues that you see in cross-border payments moving between certain currencies as well.
Yeah, sure thing. And you covered a couple of things there. I'll talk about the, what it is that exists today from a crypto perspective, and really what would we see as one of the things that are limiting adoption, right? So there's 2 things there. One is, if you look at like the on and off ramps today, so how people buy and sell crypto, a lot of wallets, etc. The only options you get today are maybe a credit card, a debit card, a bank account, right? Like that's like the 3 or 4 options that you get. But then 60% of the world still operates on cash, right? So like we're like, how does that work when somebody's unbanked or underbanked? How do they actually participate in this ecosystem that was really designed for much more mass adoption? So how do we actually get adoption there, right? So that's one aspect of the current ecosystem that I think needs to be revolutionized, need to be thought through further. The other aspect of it, which when we're talking about, so that's the consumer side of it, right? So when we talk about using digital assets from a B2B perspective, right, from a business to business perspective, one of the things that you also notice, that we've started to notice, is that when we start moving crypto assets across borders, not from a consumer to consumer perspective, but from a business to business perspective, what we start running into is that how do you get this digital asset to be something that other business can actually use to pay a bill? How can they pay for an electricity bill? How can they pay their employees using this digital asset? And that's really one of the biggest challenges that we start running into, is like, if it's something like a USDC, how can that convert to a local currency? Who will convert to a local currency for us? What are the regulatory aspects around accepting a stable coin and converting it to a local currency? So we start to run into some of those challenges. I don't know, Frank, if you can.
Yeah, I'll touch on another one. In terms of the fraud and chargeback risk, one of the things that's necessary there is to assume some level of that activity and, to charge appropriately for it, right? And which is an area of legitimate fees on these networks, right? We're asking the card networks or some of the participants to take on that risk. There's going to be an exchange of value for that. And so, if there's an opportunity to reduce the potential for that, that potentially could be, of the benefit to everybody participating on these networks, including all of us who are not, intentionally creating fraud or chargeback scenarios. We all have to pay the same fees to cover that cost. And so one of the opportunities in this network model where we're using digital assets and we're using digital identifiers is to be able to assess the reputation score of those people on the network. And today what that looks like is a lot of data collection, right? And it's part of the reason why in almost every payment, even if you're buying something that is a purely digital item, they might ask you for your first and last name, your home address, right? Information that's irrelevant for that transaction, but it's effectively, well, how do I go find you if something goes wrong? And that then results in all of these parties having to hold on to that data. Unfortunately, all of us have probably got that letter about where there's a breach, we're going to give you 1 year of identity protection. Thank you very much, right? There's no recourse, but it's just part of what they have to do to protect themselves. There's an opportunity using cryptography, using the capabilities of these networks, right? The things that we use to effectuate the money movement, right? Public and private keys, to also protect our identities, and then to have an ability to attach to that a reputation. If you're a good actor, lower fees, faster transaction times, and those things can be done whether or not you have a traditional credit score, a bank account, some of these other areas. So again, it empowers everybody to have access to building and creating a reputation that you can then use to transfer money.
And I'll just add on to that. Just speaking to fraud and chargebacks, when you think about the way the systems work today, there's a level of liability that exists, right? And typically, if you're using your credit card, making a purchase somewhere, either online or in person, the liability is on that merchant in terms of accepting your credit card with their bank. So there's a level of liability. If you didn't get the service, you didn't get the product that you were promised, obviously you can work a customer service angle, but you may not get the resolution to it and you might do a chargeback. That liability then falls on that merchant to be able to provide the proof, et cetera. So there's a lot of back and forth in there, and the system's been built in order to try to secure funds within that system for the banks, for specifically those merchants in some cases, or for the consumers from a protection standpoint. When you think about what crypto does and what decentralization of finance does, is it really flattens out that liability to be very much in the same footing. So there is, from a chargeback standpoint, what we see, and we process millions of transactions annually on various crypto coins for merchants. We see these transactions, and there are zero chargebacks. That's part of the evolution. Is there are no chargebacks. Once that transaction is made, holistically, you are making the decision to provide that merchant with your crypto, which inevitably we're accepting and then giving fiat in return. That transaction is complete. From a fraud standpoint, when you think about, again, decentralization, our wallet is we don't hold the funds, right? So we're not a custody wallet. We're a non-custodial wallet. So really, that consumer, in essence, holds their own keys. They have their own wallet. They're moving their funds, and they own those funds within the blockchain as it's entitled within their wallet. With that perspective, you have really very little chance of fraud unless you're giving your keys away. Obviously, everyone here has a cell phone. You recognize if somebody takes your phone, likely they're not going to be able to do much with it if you have your passcodes and everything else set up. So it's that same elements exist here when you think about with liability and fraud and how that changes with some of the dynamics of the ecosystem. But to Frank's point, obviously, if something does happen, there's a trail there that allows you to see what's happened to that transaction versus if your credit card gets stolen, you have no idea who stole that card.
Yeah, and one other that I'll add on, I'm sure this is something MoneyGram and similar businesses experience too, is on the liquidity side. So the ability to make a transaction look nearly instant, right, under the covers actually results in organizations having to lock up funds. The same thing exists for multinational companies, right? So they have suppliers in Japan, they're having to pay in yen. They have suppliers in Britain that they're going to pay in pounds. And maybe they're a US-based company, and so they're having to constantly manage the movement of funds globally. And because of the slow network, the bank holidays closed on weekends, and the time it takes to actually transact, they often have to keep funds in a lot of different currencies and then have currency headwinds when exchange rates don't go their way. There's a lot of really challenging issues that end up costing organizations, whether they're effectuating transfers or whether they're just trying to do business around the world, because of the slow nature of the payment system. And even as we start to see movements to things like real-time payments or FedNow here in the US, obviously in the UK and Europe, they have in Brazil and other countries, actually much faster, more efficient payment systems than we do here. But there's still the global aspect, the movement between countries, that's going to be a challenge until something like SWIFT gets upgraded. So that's another area that stablecoins and similar assets can really provide a lot of value in reducing that need to maintain all these pockets of liquidity globally.
Yeah, thank you guys. I do want to dive a little bit deeper into stablecoins specifically. We've seen blockchains being used to transfer value with networks like Bitcoin, but stablecoins really, I think, have rose to prominence over the last 4 years or so since Tether really became like the first popular one. And we've seen, I think, like the total amount of digital dollars per se in stablecoins to be almost 200 billion at one point during the bull run. So clearly a killer application for crypto in terms of adoption. Can you dive in just a little bit more specifically on how stablecoins solve some of these pain points that you guys just discussed about the traditional payment stack?
Yeah, MoneyGram has, this is not our first foray into using a digital asset. I think a few years back or a couple of years back, we had tried to work with Ripple, right? And Ripple is a great ecosystem. They were a great partner. But for us as a cross-border money remittance company, trying to use the Ripple network to also effectuate money movement while you're trying to understand what the actual asset movement or the currency movement on the other side was hard for us, right? Because now we had two moving targets. You had Ripple with XRP moving around, and then also the actual currency moving around. So when you're trying to hit two targets, it's a lot harder, right? So today, being a US company, we actually look at everything like, what does it mean from a US dollar perspective, right? And having a stable coin like USDC, which is what we use today, which is basically pegged to the dollar, and the fact that it is backed by actual reserves, and our partnership with Circle has been fantastic from that perspective. That Jeremy Allaire, the CEO of Circle, says the best. He's like, when you say like, what can you do with USDC? He was like, what can you do with the US dollar? Like, if you had $1, what could you do with it? And fortunately for us, having a stable coin that we could use to do that means that from a moving target perspective, it's no different for us than looking at a currency trade from a dollar to a local currency, right? And that makes it a lot more simpler because, especially for us, since we're a US-based company. I know that there's other stable coins pegged to other currencies, but for us, the USDC has served best because we're a US-based company.
Yeah, what we've seen is a lot of B2B transactions start to take place with USDC. And most of the time, the use cases, these are today early adopters, crypto companies that operate in the space that want to pay their AWS bill in crypto, or want to pay whatever that bill is that they have to their merchant for those services in crypto. And so oftentimes they're converting it to USDC and then moving those dollars, or those USDC dollars, across through our platform, and then we're paying those particular merchants in fiat. So that's been the biggest use case, but it is slow adoption. I think some of this is, for the previous session, the compliance and regulatory conversation, some of this is waiting for some of those guardrails to be put up so companies can feel more comfortable in using stable coins as part of their potential asset class that they're holding, or recognizing the use case and trying to get involved in it to speed up payments, as well as to support the digital ecosystem as they see the future. USDT, you mentioned, is another one we've just recently launched. We're seeing just a huge amount of business in Europe around those same elements taking place. So there's certainly there's going to be a growth that we foresee with USDC and USDT and other stable coins in the ecosystem, but we also think there's regulation that'll be tied to how much that grows and where it goes in the future.
Yeah, I think the reality, if you look at the stablecoin market, is that it is really dominated by a dollar peg stablecoin. I think it's, I haven't looked at the stat in the last week or two, but it's like 99% of all stablecoins by total assets, right, are dollar pegged stablecoins, which somewhat tells you this is a market-driven force. This wasn't regulated to be this way. It's a large demand globally for people that want dollar-denominated assets. And we won't get into some of the challenges around accessing dollar-based liquidity globally, but it is an issue for lots of people that aren't large financial institutions or central banks. So being able to provide that as a native asset, that almost anybody globally can access, is a huge deal. And particularly for those folks that, for them, the dollar is a significant protection against the instability of their local currencies. right? And so being able to actually save in dollars to protect themselves from local inflation or devaluation of their local currency is a huge savings technology for them, right? And initially, I think clearly the use for these stable coins was probably as a trading pair for assets like Bitcoin and Ether and those things years ago. But really starting to see this growth of using them as a payments technology, as a savings technology, and as a way to help people protect the savings that they've earned, and then being able to transact with them again in fairly permissionless manner. So I think there's just a huge opportunity to continue to see that growth in traditional payment use cases, whether or not the local currency is also the dollar.
Yeah, thank you guys. Steve, you touched on compliance a little bit, and since that seemed to be such an interesting topic for everyone else beforehand, I do kind of want to maybe get a personal opinion. How do you think stablecoin, or for all three of you, how should stablecoins be regulated, as that has become a very hot topic recently? Are there any systemic risks we should be concerned with this rise in stablecoin issuance that the U.S. government really doesn't have any control over?
Yeah, I'll start just to kind of repeat what I heard a little bit earlier, and some of you may have heard from the previous panel. Certainly, we recognize regulation is important. I think it's important that there's guardrails that are placed so communities, industries feel comfort and safety around the use of any of the digital currencies, and recognize that if it doesn't exist, which today it's peripheral in nature today, based upon the fact that if something goes awry, you're going to have the governments get involved, with typically going to be a FTC looking at incidents that take place, right? To avoid that, though, you want guardrails, so there are elements there that will allow for the movement and for people to feel comfort levels. And so that's when you'll have institutions that will feel better about it. Obviously, governing bodies, whether it's here in the U.S., states, internationally, begin to feel more comfortable in the use, and also then you go into the banking system. And when banks start to leverage it in a more appropriate manner, whether it's treating some of the coins as securities or looking at the current adoption model for specifically for Bitcoin being a commodity, when those take hold, then you're going to see the entire ecosystem begin to better embrace digital currencies. And with that, certainly, I think you'll see more movement in the markets, whether it's from an investment standpoint, where institutional investors will look at it more strongly, or companies using it in a more ubiquitous manner with other companies, or consumers beginning to adopt it in greater levels. And one thing we didn't talk about earlier in terms of some of the stable coins, the other instance that we're seeing is, and I think it was mentioned, Frank talked about some of the destabilization of some of the currencies globally. We're seeing use cases now where consumers in those nations are accepting USDC as an example because of the stability in it to be able to use. But then there's the off rail that Luther was talking about, being able to move the dollars off. But I think that's where regulation will come into play, where we would see it doesn't need to have so much oversight, but at least have guardrails to allow for the movement.
When you get into your car and you're driving down 75, what it actually allows you to go really fast, well, most of us think it's the accelerator. It's the fact that you have a brake, right? So if you didn't have a brake, we'd all be driving at 5 miles an hour, right? Because you don't know when you're going to stop. And that's how I kind of view personally regulations, right? So when you have regulations in place, while all of us would love to be in a world where regulation didn't exist, but when you don't have regulations, I think there's a lot more chaos in the system. And so addition of regulations over time, while initially may look like it'll slow down the growth, over time it actually fuels the growth, because people now know what can they trust, like Steve said, what can they trust and what can they not trust, right? And I was looking at this earlier, but I think at one point, just in the US, there was 4 different US dollar bills that floated around, because each bank from the Northeast or from California issued their own dollar bill. And if you look at our ecosystem today, it's not very dissimilar from when that happened, right? So I think it's just a question of time when regulation and then more uniformity catches up, and regulation kind of helps with that uniformity. And then as you see that come about is when you see the adoption follow that uniformity, right?
Yeah, the only thing I'll add there, I think the opportunity to ensure safety and soundness of the asset is important, right? And you've seen when there's questions about the reserves of certain large stable coins, what happens to their peg, what happens to the usage of their currency, right? And so I think in some sense we've seen the market itself forced towards more liquid and safe assets as the base reserve layer for these stable coins. And I think that's maybe a good balance between regulating that into effect versus the market pushing in that direction. So hopefully we'll see that more. And we've seen even banks, starting to get into this space with the USDF consortium as an example, that would be a bank issued stablecoin. I think on the regulation side, and particularly the intermediation between the physical or traditional financial system and the digital asset world, there are a lot of challenges there because the current system is based on a delayed settlement model. So for those that don't follow Caitlin Long, shout out to her. She posts a lot of great content on this space and some of the challenges that banks will face as they begin to interact with this more as regulation comes to this space. But that'll be, an area to kind of watch closely. And another, topic that I think is maybe a little bit more on the speculative side, but there are in fact some elected representatives here in the U.S. that are looking at whether or not the United States ought to adopt something like a digital asset stablecoin instead of going the central bank digital currency route, just given that the market's already there, right? It's already hundreds of billions of dollars stored in these technologies. They've been battle tested over many years. Why not that just be our digital dollar? So that's still something that's going to, I'm sure, be lots of debate, and there's bills kind of moving their way through legislation in lots of countries as to how to actually handle these things. But that's a promising area that potentially might create a free market solution to improve upon our existing payment system and banking networks.
Right, yeah, that makes sense. Like if the private sector has already created, the solution, why should the government go through creating its own CBDC when the demand is clearly shown that we already have something basically the same that's ready to go. We have about 5 more minutes, and I do want to touch on a little bit of just how your businesses are looking to solve some of the pain points on the crypto side, actually, with stablecoins. So things like off-ramping these stablecoins and how you guys are interacting with social media companies and influencers and other businesses to allow them to actually accept crypto payments.
Sure. As we touched on earlier, stablecoins are an interesting asset, right? So one of the biggest things that we're able to effectuate using USDC is the fact that to back it up a little bit, today the way we move money is that we actually have to hold reserves in all these different countries, as Frank was talking about earlier. We hold reserves in different bank accounts all across the world in order to make a movement of money look faster or appear faster, right? But if you look at what a lot of companies are trying to do, they're actually trying to effectuate global markets to certain behavior. Case in point, social media companies. A lot of social media companies, as you guys may be aware, actually pay their influencers, actually pay for people to refer a friend, right? It's easy to do that when you're in just one country, but when you're a social media channel that maybe operates, or you're just a company that operates across multiple borders, how do you effectuate those payments without having to hold reserves like a MoneyGram would, right? So that's a big challenge for a globally operating company. And one of the things that we're starting to see, which is where we're able to help, is given the fact that we have the rails that supports a stable asset, stable coin asset, we're actually able to make those payments, and then not just make those payments, but also help that user who's received the payment to actually pick up the cash, maybe on a 10 o'clock on a Saturday night, right? Which is probably when they need it the most. So the fact, I think, given that we're operating in an asset class that doesn't really rely every time on the front end from a payment perspective, on a banking structure that's probably open from Monday to Friday, typical banking hours, I think that gives us and ultimately a real person the ability to levy an asset and get access to real cash when the banks are not open.
Yeah, BitPay's in a really interesting position to be able to help the ecosystem here. While we are accepting up to now 18 cryptocurrencies for those particular individuals who want to buy, whether it's companies or consumers that hold crypto, and to make those purchases in a variety of places. One of the really interesting use cases we're right now looking at, so Twitter is one of our partners, and of course everybody knows what's happening with Twitter in the news today. And who knows, maybe very soon you'll be able to pay your $8 checkbox fee with Doge, which is what we would be processing, right? But in that instance, though, then there's the influencers on the Twitter side, which they get paid a denomination for a certain number of followers and some of the advertising, et cetera. So we're looking at providing payouts in crypto as an example to be able to push those crypto funds into that individual's wallet instead of Twitter ever handling or touching any of those funds. So there's a lot of interesting use cases that are out there that we're continuing to see. Some of the crazy things that we see in the ecosystem is right now we're processing a $15 million yacht sale. And this is likely from somebody that's held crypto for some time, an early adopter that probably has thousands of coins. They're working on cashing some of those coins out. They're trying to diversify some of their assets, et cetera. And so those are just some crazy use cases out there. But at the same time, we're also seeing more everyday use of a variety of products, and even automobiles sold just in general, right? Crypto holders either using it for a down payment or other use cases that are taking place. But more and more use cases that are happening in the ecosystem. We think that'll continue to evolve. The easier it is for merchants to understand and accept crypto, but also the easier it is for those that are holding crypto to recognize what merchants accept it and how do I want to use it, when do I want to use it. Today, if you buy it at 21 and let's prognosticate it's at 40 in a year from now, right? Cross our fingers. For just talking Bitcoin specifically. You likely would take the level of growth that you've had, right, the appreciation, the profit there, and use it for something. So those are the cases we're seeing that we've seen in the past, we'll probably see in the future. But also, again, going back to how fast you can move the funds, how easy it is, instead of thinking about credit, debit, et cetera.
Yeah, I think we're about out of time. So I'll add, the network that we're trying to build is actually a decentralized version of this global ability to move money, right? Today's system is called SWIFT. That's the messaging network that countries and banks use to move money, through the global system. And so being able to build an open alternative to that allows any financial institution, any individual to connect to facilitate those transfers. And that could look like a payment for goods or services. That could look like gig work. That could look like a cross-border payment. But ultimately, the idea is it's just like the internet. Anybody can connect, anybody can transmit, anybody can receive. And I think part of what we're excited about is actually building a trust layer on top of that enables people to connect, negotiate that connection. Just like today, you're not going to send money to an anonymous reseller who doesn't have any known entity. You can't trust whether or not you're ever going to receive the thing you purchased. You want to know something about who that other party is and how to actually trust them. The same thing will be available to build, and that'll be done in a way that anybody can connect and participate. So for those who aren't familiar with what that is, it's an open source project that we're going to build the components on, and we hope everybody else gets involved to help create a new decentralized future.
Yeah, I think that's a great way to end it off in an exciting manner. So thank you all for a fantastic panel. It's been an honor for me personally just to speak with you about this industry. So looking forward over the next 5 years, very excited for some of the revolutions in the payment space as hopefully we can start moving money quicker, faster, and instantly. So thank you.
Thank you.
Thank you.
Thanks.